Hello again, everyone. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. Today's date's Friday, August 13th, 2021, and these are my 5 most important data series and charts that I think will have the biggest influence on market direction over the next 1 to several weeks. Number 1, don't fight the trend. Tactical support is 2 to 3% below the market. And by the market, we believe the market is the S&P 500. That's generally the bogey. When somebody asks how the market's doing, we look at the S&P. The S&P 500, here's a chart back to January. It's been kind of a unique year in that although the market has not been that strong in terms of leadership, it's really been struggling to find any consistent leadership since the beginning of the year. The buy the dip urge in the S&P 500 is about as strong as I've seen it. Here you can see we came down on January 29th to test a 50-day moving average in blue, bounced back up, came back down again, actually broke the 50-day for 1 day on a closing basis, but it held this pink line, which is the trend line from the March 23rd low of last year, and came right back up again. It tested the 50-day for the 3rd time on March 25th, 2 more times in May, again twice in June, for the 7th time at the end of July. This is right around the last time that I did a Your Daily 5. It was a 1 day on either side of this support, and we talked about it then. And now we're making new highs. The tactical support is from 43.89 to 43.27, and that is the trend line again from the March 2020 lows. This August 3rd low at 43.73, and the 50-day is currently at 43.27. As long as we stay up above that area, the tactical trend is still intact. And again, the buy the dip has been incredible this year. The next thing I want to know, after I determine where the tactical support or the actionable support area is, I want to know what the internals of the market look like. I want to know if it's strong under the hood. So we have 2 tactical models here at Asbury that tell us when to be invested. In other words, risk on or risk off. One is the correction protection model, or CPM. That is more of a back-tested model that gives very clear risk-on and risk-off signals. Our Asbury 6 is a little different. Our Asbury 6 is kind of a daily health check of the market, and we put the Asbury 6 together by grouping 6 different indicators that seem to work well together. By working well, I mean no one indicator gets it right all the time. There's an Achilles heel in every indicator. Some just stop working for periods of time and then they come back. So we back tested these 6 together, and we find that they give a very good daily indication of what the internal condition of the market is, and they pick each other up when one is out of sync with the market. Only one of them, the rate of change in the S&P 500, has to do with the price of the S&P. We did that for a reason. The market has changed over the past few years, in my view. 80% of the daily volume of the U.S. stock market is computerized trading, algorithmic trading. And a lot of these algos are really pushing the markets around on a day-to-day basis. You know, you've probably seen it yourself. We break a support level in the S&P, everyone gets out. The following day, you wake up in the morning and the futures are up 30. So the Asbury 6 was designed to kind of look past that, chasing your tail following the S&P, and look at these indicators. Relative performance, investor asset flows, corporate bond spreads, trading volume, market breadth. The metric itself has been positive since July the 20th. So just about 3 weeks now, and these are the dates that all of these have turned positive. Only one is negative right now, and that's high yield corporate bond spreads. So internal's good. We're up above support. So the next thing that we like to do here is once we determine we're in a risk-on situation, what do you buy? And we have several models that do that. One of those is our SEAF model. SEAF stands for Sector ETF Asset Flows. That's been overweight the technology sector since June the 17th, and let's have a look at it. What we did here simply is we track the daily asset flows in the 11 sector spiders, and we keep track of the 2 best and the 2 worst in 3 different time frames. Trading, which is weekly, tactical, which is 21 days or monthly, and strategic, which is quarterly. By the best and the worst, the best are the ones with the biggest percentage assets in for that particular period, and those are green here, and red are the 2 that have the biggest percentage out. So what we're doing is looking for trends. So right now we've been avoiding financials and energy because that's where the biggest percentage of assets is going out in 3 time periods, and we are showing a continued trend of inflows into technology since June 17, healthcare since July 1, and consumer staples since July the 29th. This is where the money's going in the sector space. Now, since June 17th, the technology sector spider fund, XLK, has risen by 9.6% while outperforming the spider, the SPY, by 3.4%. So the model successfully got us into the right place so you could take advantage of this move higher in the overall broad market. So far all things are good, and we're overweight technology, and that is working. So now the next thing I like to watch is investor asset flows. And I do that by tracking the total net assets invested in about 200 ETFs. The one we're going to look at now is the Invesco QQQ, which tracks the NDX or the NASDAQ 100. The reason is because it's at an inflection point. Here's NDX daily with its 21-day or monthly moving average up top since April. Down at the bottom here is the total net assets invested in the Qs and their 21-day moving average, which again is Asbury Research's tactical time period. So you can see the Qs moved into a trend. The assets invested in Qs moved into a trend of monthly expansion on May the 24th, right here. And since then, that trend has produced a 12% rise in the NDX, which tracks the Qs. The nuance on this chart is that trend of expansion was tested on June 3rd, on July 19th, and 2 days ago on August the 11th. On June the 3rd, on July the 19th, the trend resumed. Assets started coming back in here again, which formed bottoms in the NDX on both dates. That same thing happened on August the 11th, and the data through yesterday, which is August the 12th, show we had a little expansion in those assets. That's a good sign. But I need to see those assets continue to expand like they did in June to drive the NDX up to higher highs and to keep the leadership that we need in the broad market. If that doesn't happen and this trend changes and rolls down underneath the 21-day, just like we had here on April 30th to May 21st, that's going to trigger a decline in the NDX, and now we've lost our leadership, which means we either find a new leader real quick or the broad market is going to move down right along with NDX. Finally, number 5, relative performance. That's another way that we like to look under the hood of the asset that we're looking at, whether it's the S&P 500 or whether it's a sector or an industry group. We like to look at the relative performance. Sometimes you see a change in the relative performance in between 2 assets before you see the outright weakness in the asset that you're focusing on. And that's what's going on here. Here's the Qs daily, the price of the Qs daily since April up top with the 200-day moving average. Down underneath is a relative performance, daily relative performance of QQQ versus SPY. And what you can see is since May the 25th, the Qs have been outperforming on a monthly basis, which is tactical for us. And we've had a strong Qs. The Qs have gone up overall as they've outperformed the S&P 500. But what you can see really here since July, we're staying above the 21-day moving average, but this relative performance has become flat. It's outperforming 2 days, underperforming 3, and just kind of hanging on to the 21-day by its fingernails. So just earlier this week, the Qs have now started to underperform SPY. That's a red flag for me. The last time that happened between April the 28th and May the 21st coincided with an 8% decline in the Qs and a coincident 8% decline in NDX. So this is problematic to me. This is making me watch those total net assets like a hawk, and it's also making me watch our SEAF model especially closely. If the SEAF model tells me that those assets are no longer going into the XLK, and or we get a trend of monthly contraction in the total net assets invested in the Qs, which was the previous slide, that's going to tell me we're losing our leadership, and that could be the trigger, the first sign that we're going into a long overdue correction in the broad market. So there's your daily 5 for today. If you like our approach to markets, feel free to visit us at www.asburyresearch.com. You could sign up for a bi-weekly update that we put out to interested people, people that are interested in our services, to just kind of let them know how we look at markets and what we're doing in the markets. And thanks very much for watching, and we will see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.